Hey everyone, and welcome to another deep dive. And this one is brought to you by Frugal Living Man, helping you make smart financial decisions, which is something we all need to be doing, especially after the news we're going to unpack today. We're doing a deep dive on the latest Federal Open Market Committee statement. The FOMC, straight from their January 29th, 2025 meeting. I know what you're thinking. This is about as exciting as watching paint dry. But stick with me here. This isn't just some dry financial jargon. We're talking about a decision that affects you, your wallet, and potentially your entire financial future.
Yeah, that's right. These decisions, they can have a ripple effect throughout the economy, impacting things like mortgage rates, savings interest rates, and even business loans.
So let's break it down. Starting with the FOMC's snapshot of the current U.S. economy. They said economic activity is expanding at a solid pace. Unemployment is stable and low, and the labor market is strong. Sounds pretty good on the surface, right?
It does, but you have to remember, the FOMC is always looking ahead, almost like those chess grandmasters, thinking 5 moves ahead. And what they see is inflation. Inflation's still hovering a bit higher than they'd like it to be. That solid pace of growth could easily turn into an overheat, and then that would just fuel inflation even more. So it's a delicate balancing act.
Okay, so that's kind of the economic backdrop. Now for the main event, the interest rate decision. What did the FOMC decide?
Well, after much anticipation, they decided to keep the target range for the federal funds rate unchanged at 4.25 to 4.5%.
So hold steady for now. What's the logic behind that, especially with inflation still on their radar?
Well, remember what I said about thinking 5 moves ahead? Monetary policy. Those interest rate changes, they don't have an immediate impact. It takes time for those ripples to reach the edges of the pond, so to speak. The FOMC is being cautious. They want to see how the previous rate hikes, and there have been a few, are really impacting the economy before they make any further adjustments. It's a bit like waiting for the cake to bake before you add more frosting. You don't want to mess up a good thing.
Makes sense. They're playing the long game. But what does this holding steady actually mean for people like you and me? Should we be breaking out the champagne or tightening our belts?
It depends. For borrowers, this could be a sigh of relief. Holding rates steady means that those interest rates on loans, like mortgages, might stabilize or even dip slightly. So if you've been thinking about refinancing your mortgage, now might be the time to lock in a rate. On the other hand, for savers, this means those interest rates on savings accounts are likely to remain relatively low. So you might not see your nest egg grow as quickly as you'd hoped.
So it's kind of a mixed bag, depending on your financial situation. What else should we be paying attention to in this FOMC statement?
Well, one thing that caught my eye is the FOMC's continued commitment to reducing their holdings of Treasury securities and agency mortgage-backed securities.
Okay. I'll admit, that sounds a little bit technical. Can you break that down for us?
Sure. Remember how the FOMC pumped money into the economy during the pandemic? Kind of like using a giant watering can to keep the economy blooming? Well, now they're slowly turning off the tap. They're selling off those assets, bonds and mortgage-backed securities, which gradually reduces the amount of money circulating in the economy.
So it's like they're trying to dry out the soil a bit so the economy doesn't get waterlogged?
Exactly. It's a process called quantitative tightening. And it's another tool they're using to try and tame inflation.
It's fascinating how all these pieces fit together, but I'm curious. They keep mentioning this. This uncertain economic outlook. What exactly are they uncertain about?
Well, there are a lot of factors at play. Global economic conditions, for example, can have a significant impact on the U.S. economy. And then there's the ongoing uncertainty surrounding trade policies and, geopolitical events. These are all wild cards that could throw a wrench in the FOMC's plans.
So they're walking a tightrope.
Yeah.
Trying to balance inflation with growth, all while navigating these external factors.
Precisely. And that's why the FOMC emphasizes its data-driven approach. They're constantly monitoring a whole range of economic indicators, from employment numbers to consumer spending to inflation gauges.
They're like economic detectives, always searching for clues about where the economy is heading next.
That's a great analogy. And based on those clues, they'll adjust their monetary policy accordingly. They're not afraid to change course if the data tells them to.
That's reassuring, knowing they're not just blindly following a set path. But what does all this mean for the average person, trying to make sense of their own finances?
I think the biggest takeaway here is that we're in a period of transition and uncertainty. The economy is still adjusting to the post-pandemic world, and the FOMC is trying to steer it towards a soft landing.
So, what advice would you give to our listeners who are trying to make smart financial decisions in this kind of environment?
First and foremost, stay informed, keep your finger on the pulse of economic news, and try to understand how these developments might impact your personal finances.
Don't bury your head in the sand.
Exactly. And secondly, be adaptable. The economic landscape is constantly shifting, so be prepared to adjust your financial strategies as needed.
Don't be afraid to pivot.
Exactly. And finally, don't panic. The economy goes through cycles, and we've weathered storms before.
Solid advice. Now, I know we've been talking a lot about the big picture, but let's bring it back down to a personal level. The FOMC is focused on inflation and employment. But how might their decisions actually influence someone's personal financial goals, like buying a house or saving for retirement?
Well, let's say you're thinking about buying a house. The FOMC's decision to hold interest rates steady could mean that mortgage rates remain relatively stable, making it a good time to lock in a rate.
So seize the opportunity if it aligns with your goals.
Exactly. But on the other hand, if inflation remains persistent and the FOMC is forced to raise rates down the line, those mortgage rates could climb, making it more expensive to borrow money. So it's a bit of a gamble.
A calculated risk, you might say. What about saving for retirement?
Well, with interest rates on savings accounts remaining low, you might want to consider other investment options that could potentially offer higher returns, while being mindful of your risk tolerance, of course.
Diversify.
That-
Diversify.
Exactly. And this is where our sponsor, Frugal Living Man, can really come in handy. They have a ton of resources and tips on making smart financial decisions, no matter what the economic climate throws your way.
They're like a financial Sherpa, guiding you through the treacherous mountain passes of personal finance.
I like that. But jokes aside, they really are a great resource for anyone looking to take control of their financial future.
All right. So we've covered a lot of ground here. We've talked about the FOMC's decision to hold interest rates steady, their ongoing efforts to tame inflation, and what it all means for our listeners' personal finances. But before we wrap up, I want to leave you with one final thought. We've talked about this balancing act that the FOMC is trying to pull off right, keeping inflation in check, but at the same time supporting a healthy job market. But here's the thing. These decisions are not made in a vacuum. They're made by real people, the voting members of the FOMC. We're talking about some of the most influential figures in finance, and their individual perspectives can shape the direction of the entire U.S. economy. So who are these people?
Well, the FOMC, it's composed of 12 members, 7 members from the Board of Governors of the Federal Reserve System, the President of the Federal Reserve Bank of New York, and 4 other Reserve Bank presidents who rotate in on one-year terms.
So it's a team effort, not just one person calling all the shots. But what I find interesting is that these members, they come from different backgrounds, different schools of economic thought. You've got folks who might lean more hawkish on inflation, others who are more focused on employment. How do they reach a consensus with all these different viewpoints in the room?
That's where the real magic happens. These FOMC meetings, they're not just a formality. You know, it's an opportunity for robust debate and analysis. Each member brings their own expertise and perspective to the table. They challenge each other's assumptions, and they really hash things out. And sometimes they disagree, publicly even. You know, it's not always a harmonious symphony.
Which I find reassuring, honestly, because it means these decisions, they're not being made lightly or without considering a range of potential outcomes. They're really digging into the data, weighing the risks, and ultimately trying to find the best path forward for the economy.
Exactly. They're not just looking at spreadsheets. They're considering the real-world impact of their decisions on businesses, on families, on individuals like you and me.
So it's not just an academic exercise. These decisions have real consequences. Which brings us back to you, our listener. We've unpacked the FOMC statement, we've explored the economic landscape, and we've talked about the people behind these decisions. But now it's time to connect it all back to your financial life.
Think about your own financial goals. Are you saving for a down payment on a house? Planning for retirement? Trying to manage debt? The FOMC's actions have a direct impact on all of these things. So as you make your own financial decisions in the coming months, keep this information in mind, stay informed, be adaptable, and remember, you have the power to navigate this complex financial landscape.
Exactly. And if you need a little help along the way, remember, our sponsor, Frugal Living Man, has your back. They offer tons of practical tips and resources to help you make smart financial choices.
Absolutely. And remember, knowledge is power. The more you understand about the economy and how it works, the better equipped you'll be to make informed decisions and achieve your financial goals.
To stay curious, stay informed. And until next time, thanks for joining us on The Deep Dive.